Hi, and welcome back. Today we're going to take a look at investing in stocks. In fact, this is the first in a series of investment videos that are going to look at different types of investments, including stocks, bonds, mutual funds, and exchange-traded funds. It's part of our course in personal financial planning at VIU, and as we stand right now, we're about halfway through the course. We've already covered the insurance products, things like buying a house, and we'll be moving forward looking more specifically at investments and retirement planning over the next couple of weeks. Today's session specifically takes a look at the material that's covered in Chapter 10 and 11 in the Madura and Gale textbook. We're only going to cover part of the material, and so I want to make sure that you read that material as well. We're not going to cover everything in 2 chapters in today's short video introduction. I also wanted to mention that one of the most important things about investing in equities is practice. Take a look at different equities and try investing in them. And for the purposes of this course, I've set up a very simple investment game at MarketWatch. You'll see it's listed under Virtual Stock Exchange. There's a link in the email that I sent earlier. You'll have $100,000 to invest in stocks. I'm going to invest in a couple. I see today I've already made about $1,000 by short selling Tesla stock. I'll talk a little bit about that in our Tuesday class. So just a heads up, that's something you might find interesting if you haven't already found that. Before I talk about equities especially, I like to refer to the Know Your Client rule. And that's because whenever I talk to people about stocks, I want to make sure they don't believe that I'm giving them stock advice, and that includes talking to you folks. Any of the stocks that I mentioned today are not intended to be a recommendation to buy or sell those stocks. And that's because I really don't know about your personal situation. I don't know about your feelings about risk and return. I don't know about your time horizons or any other kinds of assets that you've got. And for that reason, when an investment professional is working with you, the first thing they'll do is fill out a questionnaire. You can see there's information about that Know Your Client rule and the type of questionnaires that they use at the Investment Industry Regulatory Organization of Canada, or IIROC, website. And we'll talk a little bit more about that later in the course. This is something that's important for you as well. As you become more knowledgeable about investments, you become more liable for the advice that you give. And if you really haven't made an effort to show that you have made you've interviewed your client, you've got their best interests at heart, then you could be liable for some of the recommendations that you make. Only the bad ones, not the good ones. Now, today's session is all about equities. It's only one class of investment. We'll be talking about more later. And some of the general concepts of risk and return that are valid for all types of investments will also be discussed today. We have had investments in equities as long as we've had public companies. And we've had public companies going right back to the earliest joint stock companies that were created to explore the modern world. Equities became especially important when we built large corporations, steel mills, railroads, and utility companies like British Columbia Telephone Company, or as we know it now, TELUS, goes back a long way. Governments have always been involved to some degree in this. In fact, one of the earliest promotion schemes in British Columbia was called the BC Resources Investment Corporation. And if you were a citizen going back into the 1980s and 1990s, you were entitled to 5 free shares in the BC Resources Investment Corporation. Somewhere in my office, I still have my 5 free shares. They're completely worthless, or I think they're worth something like 0.0016 cents, because the company did not do very well. But it was an effort to encourage individuals to buy stocks, to own shares in companies that were set up in Canada. That's been one of the major efforts of governments all along, to create wide ownership, to create a capitalist culture. And so for that reason, we see things like the BC Resources Investment Corporation. Now, stocks or shares in a company represent partial ownership of a firm. You are not just providing money for management to use, but you become an owner, even if you only own a few shares. If you own enough shares, then you become a significant shareholder and your vote starts to count. But largely, most companies are still significantly controlled by institutional investors. So buying shares in a company does give you a stake, but most importantly, it does give you a right to certain types of return in the company. Understanding investments is also going to be quite a major challenge. You can see that everybody or anybody can be a stock market expert. Now, like in this Dilbert cartoon, basically says that, the advisor says everybody should own shares, even if they're significantly overpriced and even if the advisor themselves has got conflicts of interest. And for every bit of bad advice, there are a lot of people who are willing to take that advice. We saw that last summer when we were looking at the Robinhood phenomena and several small retail investors who managed to completely distort markets in certain stocks, something we'll come back to a little bit later in today's session. Now, you can see why people like equities. There's an awful lot of interesting action in certain markets. People are talking about certain stocks all the time. They become quite volatile because new information is provided, and every time new information comes into the market, we reassess the value of that stock or the present value of the cash flows. One of my favorite companies to look at these days, not necessarily that it's good investment, is Tesla. And that's partly because its main shareholder has a real habit of getting his name in the news on a regular basis for good reasons as well as bad reasons. And that affects share prices as people start to reconsider what's going to happen in the future. There are a lot of unknowns in a company like this. There's unknown technology. There's certainly a question about how the company is going to be able to produce in the future, any kind of regulatory restrictions that may happen, the markets that they're going to operate, and the products that they're likely to sell. So for that reason, on a given day, the share price can move by 5 or 6%. It's not that the company's real value changes, it's our perception of that value and how it changes. We have a lot of information sources. The next couple slides do show information that comes from a variety of different sources, from Morningstar, from MarketWatch. Here we can see some basic information about the company, including its share price at the close of trade on the most recent days, and even after hours, because there is some trading that happens on wholesale markets. We have the change for the day. This company's share price changed by $18.66 during the day for a 2.54% total change. We have some more information that comes from analysts, and in fact all of the information on the bottom half of the slide says that there are about 45 different analysts who write about this stock, usually on a quarterly basis. They have got estimates or predictions on the earnings per share in the future, and hence the future cash flows. And we can see that we expect the cash flows are going to rise into the future, going from an average of about $6 per share to $11 to $16 to almost $20 per share by 2024. So with that kind of information available from the brokers, we can start to form our own opinion for what we think is going to happen and use that to interpret news as it becomes available. From a Morningstar report, you can see that people's opinion on whether or not the stock is overpriced or underpriced. In other words, if it's a good value, if it's underpriced. If it's overpriced, people say that it's definitely not a good value and maybe we should sell the shares. In the last few months, you can see that analysts in general believe that the stock was overpriced, and perhaps now as the share price has fallen, many believe that it could be undervalued. And undervalued means that perhaps this is a buying opportunity. Not a fact and certainly not a recommendation, but that's something we should use to temper our own buying behavior. We can get a lot of information just from the share price itself. This is described as technical analysis. We'll talk about it later. But it also describes the way that the stock price moves on a day-to-day basis, but also taking a look at averages over time. These blue lines on the chart represent the high and low prediction values based on a probability distribution. And these are Bollinger Bands. The red and the green bars represent the daily trading behavior. A long red candlestick in this case, these red bars, the candlesticks, represent a very large fall in one trading period, and the green ones represent a positive change. So they started at the beginning of the trading period going up. They went as high as the top of this little wick on the top of the candle, and then closed very close to the high price for the day. We also have at the bottom of the chart information about the company's trading volumes. If a lot of people are trading, there's a lot of interest, then that predicts extra volatility. Of course, green is good, so that's a trading session when the price went up, and red is bad, a session when the price went down. Very large spikes means that there probably was a lot of new information that was attained during that particular trading period. We'll talk a little bit more about technical analysis later. Why do individuals hold stock? Well, clearly holding equities, holding stock is much riskier than many of the alternatives. And we'll talk about alternatives later, but they could include things like buying real estate, having a GIC, putting some money into bond markets, investing in alternative investments like private equity or commodities and futures. So this is just one of many different alternatives. And we would normally hold stock because we expect to receive higher returns than at least some of those other alternatives, some of the safer alternatives like GICs, bonds, and perhaps real estate. Here we've got a quick summary of some of those other alternatives. Very low risk at the bottom of the pyramid includes things like debt securities, savings bonds, term deposits, Canada savings bonds, treasury bills. These type of safe investments are characterized as being perhaps important to meeting your short-term goals because they're liquid. You can cash them in as you need them. They can provide emergency funds. They're very good for collateral if you're going to use them to borrow, especially in the short term. Of course, having a house is also another type of investment, and houses tend to rise in value with inflation, so you get some inflation protection, and you expect that real growth will be reflected in the value of your house, at least over a long period of time. We have got common shares, regular ordinary shares, preferred shares, other types of equities are medium risk. They're probably better for long-term goals. You don't want to put money into the stock market today and get it out next week because of transaction costs, but also because in the short term, equities can be much more volatile than some of those other classes of assets. So you wouldn't want to invest at a high price and have to withdraw the money at a lower price. You can get capital gains from common equity, but you also can create those gains by taking riskier investments like investing in options, and we'll talk about those later, and growth stocks, tech stocks, mining stocks, other types of high growth stocks. And then we have the riskier categories, which include things like futures, metals, spot market investments in gold or silver, for example. Bitcoin would also be in here. Commodities, and perhaps also other types of investments like private equity. We don't get income from these kinds of investments, so we describe them as being principally about a capital gain, selling them for more than we paid for them. Now, this is, again, a very brief summary of alternatives to investing in equities. So if our priority is going to be something like income, putting money into certain types of investments like real estate investment trusts, common shares that provide high dividend payouts, preferred shares, bonds, those provide us with regular income. Very good if you need a steady cash flow, if you're a pensioner, a widow, an orphan, an insurance company that needs to be able to pay claims from their income. These are the type of investments we'd use. If our main objective is to have a larger capital gain, stocks are good in general, especially high growth stocks. Equity mutual funds or exchange traded funds and usually real estate. High liquidity includes things like Canada Savings Bonds, GICs, putting your money in a checking account, and perhaps mutual funds. Tax-protected yields include things like capital gains that are paid on top of dividends, gains from sale on real estate, gains from investment in certain types of commodities. Inflation protection comes from anything that maintains its value regardless of the dollar price. So high-yielding common shares, preferred shares, stocks with capital gain potential, high-yielding bonds are good for inflation protection, as is real estate. And simple to manage, especially if you've got a small amount of money invested, include things like savings accounts, savings bonds, and guaranteed investment certificates. Now, we also need to take into account risk, and there's always going to be the risk-return trade-off that we describe in other courses with the security market line. And essentially that's the trade-off between expected return, a high return at the top, and risk. Risk measured by standard deviation of return, or perhaps the beta if we're talking about equity. If we're down in the bottom left-hand corner, we do have very low risk, but we also expect low return. Cash is probably the least risky and certainly the lowest return, with probably a 0% rate of return to holding cash. Then we have things like deposits with major banks, Canada Savings Bonds, investment in money market funds and treasury bills, Government of Canada bonds. And in fact, for all of these, the only risk that we have is inflation. Canada Savings Bonds, you know the government will not default, but what you don't know is how much your money will be worth when you take it out. Then we start to get into corporate bonds, a little bit riskier than Government of Canada bonds, still relatively low risk, but there is some risk of default. Then we have common shares. Common shares can lose value. In fact, the company can even go bankrupt. So now we're starting to get into real risk. Then we have things like real estate. Tech stocks or high growth stocks are higher up on the spectrum as well. Higher risk of failure, higher risk of loss of value. And then we start to get into other things like metals, commodities, private equity investments, and so on. In fact, right up here at the top, we should probably have lottery tickets, because in some people's mind, a lottery ticket is an investment. About 20% of British Columbians, when asked about their investment decisions, included lottery tickets as part of their investments. Not very good chance of a payout, but if you do get a payday, hopefully it's a big one. Some of the returns that we get, well, there are two principal sources of return. You can earn money from dividends. Not every company pays dividends. In fact, even in the long term, many companies will not. So dividend yield if it's available. If there is no dividend yield, then hopefully we receive capital gains. We have very different type of customers for these two types of returns. As I mentioned before, the widows and the orphans, the insurance companies, they like to have their dividend yield. Of course, when you receive a dividend, it's taxable income. So you have to give part of that money when you receive the dividend back to the government in the form of taxes. It becomes part of your income. Capital gains, on the other hand, only happen when we sell the stock. So if we sell our shares, then we receive more than we paid for them, we have a capital gain, which then gets taxed at a lower rate. The rate of total return then comes from these two sources, dividend yield and capital gain. Dividend yield is simply measured as the cash value of the dividend actually received divided by the original price. So if we have a dollar in dividends and $10 in original price, then that's a 10% yield. Again, multiply it by 100 to turn it into a percent, and then add that to the capital gains yield. And capital gains is the difference between the selling and the purchase price divided by that original purchase price. And let's say that we have a $120 selling price, a $100 purchase price. So $20 divided by 100 would be a 20% yield. 20% capital gain, 10% dividend yield gives us a 30% overall return, the total return. Now, the price of a stock is clearly the price at which we buy it today. So that's the market price. Much more interesting and probably more important in the long term is the fair market price, or the intrinsic value. Intrinsic value is essentially going to be determined by the value of all of the future benefits that we receive from holding the stock. So if that means dividends or earnings, or perhaps a big payout when we sell the shares 5 or 10 or 20 years in the future, that's all part of that intrinsic value. The simplest way to measure that would be with a dividend growth model that we refer to in the textbook. Gordon's growth model, or dividend growth model, is essentially a way of measuring the value in perpetuity of cash flows received. We don't do very much on valuation in this session, in this course as well. That's something we'll take a look at in some of our later courses in this degree program. Some of the things that affect share price, include the type of business it is and how it's affected by business cycles. You can see right now when people start talking about recession, commodity stocks don't do very well because commodities can lose a lot of value in the recession stage of a business cycle. Companies like Teck Resources, which gets part of its income from lead, zinc, and especially copper, will lose value as people start to become concerned about the commodity cycle. Interest rates may be important for certain businesses, including companies that are rate sensitive, companies with a lot of capital investment, including banks, real estate companies, but also large industrial companies. Investor sentiment becomes quite important. It's not reality that is the problem. The problem is perception. What do people believe is going to happen next? That's where we start to talk about things like fear. Right now, as of yesterday, looking at the CNN Fear Index, we have quite a high value between fear and approaching extreme fear expressed by people in the market. And we also see the trend in the Fear Index is getting an awful lot worse. Well, actually, last week it was down to extreme fear. But maybe we had a little bit of good news earlier in this week. In fact, gas prices and the fear of inflation actually moderated just a little bit in the last couple days. So people are concerned, but they're not quite panicking yet. That has got implications for the market. When people start to become less fearful, they start to think about making some money. And that's where we move into greed and extreme greed, where the markets become overly optimistic, perhaps. There are several different ways to analyze a market. The two principal ones that we talk about are fundamental and technical analysis. Fundamental analysis means that we believe as investors there is inherent value in a company. Investors like Warren Buffett, for example, believe that by looking at the future cash flows from a company, we can recognize value. And if a company or an industry is undervalued, he buys it. So he is the archetypical value investor. Taking a look at financial statements, predicting future values, trying to do a qualitative analysis looking at things like the competitive advantage that the company may have within an industry and the nature of the markets in which they're operating in. Even management skill can be part of our fundamental analysis. Technical analysis essentially says that that stuff isn't important. The information that we need for technical analysis comes from essentially the share price today and the volatility or the uncertainty of that share price. And so by taking a look at patterns in trading and the behavioral analysis of investors, we can predict what's going to happen next. Now, I know personally I fall more into the category with Warren Buffett of being a value investor. Many people will say that technical analysis does provide at least some short-term information, although we know that empirically there's not much support for technical analysis. Trading in stocks principally happens through organized exchanges, but also over the counter. Stock markets like the Toronto Stock Exchange, the New York Exchange, are markets that are organized by companies now. They did used to be mutual organizations where individual brokers held a share. So if you were a member of the Toronto Stock Exchange, you were actually part of a club. Now, Toronto Stock Exchange is part of an international conglomerate that is owned and publicly traded, as is as are other exchanges like the New York Stock Exchange, the Frankfurt Exchange, the London Exchange, and so on. Over-the-counter markets essentially happen electronically. The original organized electronic exchange was NASDAQ, which stands for the North American Share Dealers Automated Quotation System. It's expanded into a worldwide network essentially, and operates at least partly in competition with the Toronto Stock Exchange, the New York Stock Exchange, and other exchanges that, at least in the past, used to be physical exchanges. Some of the things that we need to know about when we're talking about exchanges and trading on exchanges is the type of trading that we do. If you do want to buy a company shares, you will need the ticker symbol, not necessarily the name. So if we're looking for somebody like Tesla, it has a 4-letter ticker symbol, TSLA. In many cases, those ticker symbols represent trading at a time when information was communicated by a telegraph, and ticker tape was essentially produced by a machine hundreds or thousands of miles away, so you had to keep the information really short. So, for example, a company like AT&T would have a symbol of A and of T, and so you knew that T and then the value that came after that was the current share price. We'll talk a little bit in this part of the session about how shares operate, how shares are traded, the types of orders. First off, we need to look at the types of orders. Almost all of the type of accounts that we're dealing with are cash accounts. In other words, we settle for cash. You have to pay the purchase price for the securities, even if it's a transfer from your own account. So if I have $1,000 in my trading account and I buy $900, then that's still a cash account. Margin account means that I have agreed to a line of credit with my stockbroker who will allow me to actually invest more than my current level of cash in the account. So if I have $1,000 in the account and I want to buy $1,500 worth of shares, I can do that by investing $1,000 of my money and borrowing the rest from the broker. Wrap accounts are brokerage accounts where the brokers match money with other funds that they have available. So essentially they're leveraging your investment. It reduces the transaction costs. There are several different types of orders. Almost all of the orders that we'll be making, if you're investing in our trading game, are market orders. Market orders are essentially an order at today's price. We have other types of orders that are going to be, we'll talk about in the next couple slides certainly, including open orders, stop loss orders, and limit orders. And as I said before, a market order is essentially an order to buy or sell shares in the company at the current price. If it's a relatively small order, when I hit the button saying please trade during normal trading hours, the order will go through probably within milliseconds, maybe seconds, depending on how much trade there is in that particular stock. So if I buy a commonly traded stock like Apple or Microsoft, as soon as I hit the button, I will see that the order's been filled. Essentially goes into a type of an order book, and the next available shares to purchase will fill that order. If I buy shares in a less commonly traded company, like a junior mining company, it might take a few hours or even days to fill a market order, depending on the stocks available for sale and how effective and efficient the market is. An open order essentially says that we're going to make an order that will only be executed if the share price falls below a certain level. So we can put in an order at if the current price is 100 and make an order to buy at 90, and if the price falls to that level during the current trading session or until a specified point in time, the order will be executed. We'll take a look at a stop loss order in just a second, and here it is. It's essentially an order to sell your shares if the shares fall more than a certain value or a certain percent. So if you have bought shares at 100, you're holding them in your portfolio, you'll say, if that price falls below 85, I want you to sell it. And you can make that for the session or for the day or until you cancel the order. And what will happen then is whenever the price falls below that certain price, it will limit your exposure, limit your loss to that particular minimum price. Again, the reverse of the open order that we just talked about. A limit order is essentially an order to buy or sell shares up to but not beyond a certain price. Of course, this means that you won't be guaranteed completion. And for example, a few years ago, I wanted to buy shares in Amazon, which were currently trading around $950. I thought that sounds awfully high, but I'll buy them. But let's see if the price falls. So I put in an order at $920. By the end of the day, the price went over $1,000 a share, and it stuck there, which is unusual trading behavior. And so the next day I thought, well, I didn't get my shares yesterday, I'll try today, but I think they're going to fall down below 1,000. Usually there's buyer's remorse and the price falls a bit. I'll put in an order for $990. The price went up to $1,100 that day. It never fell during the trading session below 1,000. My order didn't fill. I tried for about 3 days, increasing my price every day for 3 days, and gave up at around $1,200 a share. Within a year, the price was up to about $3,700, and I missed out. So a limit order does not guarantee completion, and that's the most important thing. It gives you an opportunity to buy at a lower price, to buy on the dip, but it doesn't necessarily mean you're going to be successful. A topic that really baffles most people is short selling. Now, typically when we buy a share, it's because we expect the share price to appreciate. We're going to take advantage of that capital gain. What if we believe the company is going to lose value? Something bad is going to happen. Perhaps we don't have certain knowledge, but we have an expectation. We believe the stock is overpriced, for example. If we said, today's price for Tesla is $780 a share, I think it's probably only worth $750. And I think that change, that price is going to happen, that drop is going to happen really quickly. Also, if there's a lot of volatility in the stock, there's a much better chance that the price is going to fall. So in this case, to make money on the downside, I use a short sale. The execution itself is a little bit complicated. I phone up my broker and say, hey Bob, I want to short Tesla. Current price is $780. And I'd like to short 100 shares of Tesla. Bob will go into essentially a database of sales of shares that can be borrowed, perhaps held by his brokerage or other brokerages, and he will borrow on my behalf at $780 a share. If, as I expect, the price falls to $750, I'll phone Bob up and say, hey Bob, I want to close up my short position on Tesla. Buy at $750, those 100 shares. Bob executes, he buys the shares at $750, and he uses those to replace the shares that I borrowed at $780. The difference is $30 per share, and that becomes my profit. 100 shares times the $30 per share, less a tiny bit for the owner of the share. They get to keep that money as their kind of interest for allowing their shares to be used in a short. Of course, when I mention a company like Tesla, you think that must happen all the time, and it does. In fact, there's so many people shorting Tesla on such a regular basis that's become a phenomena, something called a short interest problem or a short squeeze, something we talk about perhaps in one of our later courses. Now, Bob, my broker, is kind of becoming a rarity because we don't have very many stock brokers anymore. The idea of a full-service stockbroker was somebody who would be there on the phone, would complete a ticket, communicate that information to a trading desk inside their own brokerage, who would then trade on my behalf on an organized exchange. Of course, now almost all trading happens electronically, so either I can go directly through my brokerage organization without talking to a human for advice, and so the full-service stockbroker has become more of a rarity. Because they are human, they require commissions, they require additional costs, so that particular approach would be a little bit more expensive. In fact, most financial institutions, as well as having full-service operations, have also got a direct operation, a discount stock brokerage with much lower commissions. And, of course, over the last 20 years, we've seen the rise of a number of electronic brokers, starting off with E-Trade, which I think is now part of JP Morgan, or in Canada, it's run through Scotiabank, and they call it iTrade. Charles Schwab, who are expanding into Canada at the moment, also a major dealer. Royal Direct, TD Waterhouse, CIBC has got their own direct trading operation. Just about all of those organizations we recognize because, well, they are the extension of the historical investment dealers that we've always had. We have seen the rise of a whole new class of investment opportunities, including organizations like Wealthsimple or Robinhood. And Robinhood, as I mentioned earlier, got in the news last summer because a lot of Robinhood investors read about opportunities on platforms like Reddit and would decide now's a really good time to take a run at a particular stock. Perhaps a stock that had been trading at a low value and a stock that had been regularly shorted. Through this type of parallel communication on Reddit, they created a run on several companies, pushing up the price and practically destroying a number of professional investors and hedge funds who were making money from shorting those companies. So Robinhood is actually a trading platform, but like every other broker, they don't deal directly with the markets. They go through a market maker. And in this case, they've managed to provide very low cost, and in fact zero transaction cost trades, but they've done that by working with some of the market makers. And unfortunately for a lot of the investors, the payment for order flow approach that they use creates a lot of hidden costs for investors. So, yes, you are not paying an upfront transaction fee, but you don't always get the best price on an investment if you're being used in this payment for order flow approach. If you are interested in using a platform like Robinhood, I do highly recommend that you take a look at some of the information that's available on the internet. In fact, there's a great article, great podcast by Jon Stewart summarizing exactly how payment for order flow works. The stock indexes or indices essentially are ways of tracking the overall performance for the entire market over that particular trading period. Not only are there market indices for all the major organized markets, but there are sub-indices that track particular categories within those indices, or within certain countries, or within certain types of classified markets, like the BRIC markets. So we have regular access to some of the better known ones, including things like the Standard & Poor's Toronto Stock Exchange Composite Index, the NASDAQ Index, the New York Stock Exchange, and so on. And sub-indices like the Toronto Stock Exchange Venture Exchange Index or commodity indices. Again, if I take a look at a trading platform like TradingView here, I can see, well, the market hasn't looked very good for the last few months. In fact, since January, February, we had pretty healthy markets, but April, May, June, July, markets are down by a significant amount from the peak that we saw. That looks like mid-April. So how are our stocks doing? Well, how well they're doing relative to the market is part of that great question. We can invest directly in a market without having to invest in the components or the stocks that are traded in the market using things like exchange-traded funds. These are a type of mini mutual fund that trade on stock markets. We can buy them directly, and they're organized typically by investment banks and organizations like BlackRock, who will actually take the money that you give them and go out and buy a little bit of everything on the market, so that the ETF perfectly tracks the Standard & Poor's index. It's a great way for a small investor to start playing with equities. Buy a little bit of everything, be fully diversified, and you don't really require additional information about the individual parts or components of that ETF. Also, they have a very low management expense ratio. In other words, the cost of the transaction is very, very low, perhaps as low as 0.1% or 0.05% for some US ETFs. And it allows you to invest and to get all of or almost all of your gains back rather than give them up to the investment manager. We will talk about ETFs a little bit later in the course, but just to be aware that we do have things like spiders, cubes, diamonds, vipers. These are marketing products or marketing brands that have been applied to say that this is a type of an ETF that tracks this particular exchange. So, for example, if I was interested in having a stake in what happens in the Standard & Poor's TSX index, a fund by the name of iShares, which is owned by BlackRock, has got a particular stock called XIC. And that's an ETF, and it tracks the Standard & Poor's Composite Index. If you compare this particular chart to the one that I showed you a few slides back, you'll see that it pretty well is exactly the same. And that's because it includes a little bit of everything that's in the Toronto Stock Exchange. Now, back to stocks. We have a couple of different types of stock, common shares, preferred shares. There are a number of special classified shares as well. We won't get into all of those details, but we'll just stick with the two main types for now. Common shares give you a stake in the ownership of the company. That means as an owner of the company, you have a claim to the income equal to all other shareholders. The family that owned the business, I should say, the other investors, the large institutional investors, if they get a 1% dividend from the company, then that's what you're entitled to. Equal share in whatever residual income there is after paying the expenses. You also have a vote in the company, unless it's a classified share, that's equal to the vote for any other common share in the company. I see. Some companies do have special rules. For example, Rogers has got classified shares, Canadian Tire, Onyx, and so on. So you might not have full voting rights, but in a full common share you do. If the company goes broke, you've got an equal claim on whatever company assets are left over after everybody else has been paid off. You do face higher risk than with preferred shares because they have a higher claim on those assets, but a lower risk means a lower return. Preferred shares typically provide a preferred dividend, a fixed dividend unless certain things happen. If dividends are not paid for any reason, then the dividends typically accumulate until the company's got some spare cash, and then when the dividend can be paid, it has to be paid to the preferred shareholders before the common shareholders can have anything. You don't get a vote, which is generally not a big problem because most common shareholders don't really buy shares in the company to vote anyway. You have a higher claim on any assets in the case of distribution if the company dissolves, goes bankrupt. And because of the above things, you have a lower risk than those common shares. Preemptive rights essentially means that you have a right of first refusal on any new shares that are issued. So if the company does a secondary issue, they go back and they sell some more shares, then you have a right to buy those shares in proportion to your current holdings. So if you own 5% of the company now, you have a right to buy 5% of those new shares. It protects you as an existing owner from some kind of dilution in your stake in the company. Some stocks might also come with a special feature A warrant. It's like a coupon that's attached to your shares that allows you to buy additional shares for a set price for a particular period of time, or at a particular period of time. So if the company does have huge amount of growth, you want to double your investment, this allows you to take advantage of that. It's like a loyalty scheme that's involved with the stock. If you pay extra for warrants, they're high risk because there's a chance that you might never execute them. In that respect, they work like option contracts, and they're priced like option contracts. This has been a very, very quick introduction to the idea of equities. We teach whole courses about equities and equity valuation. I can talk about those a little bit in class. There are a couple of other alternatives that we'll be looking at in later chapters and a later video. These include things like mutual funds and exchange-traded funds. I have already said a few words about exchange-traded funds. Mutual funds are essentially pooled funds where a professional manager, a mutual fund company, will operate a mutual fund itself within that company, where the shares in the fund will belong to you as one of the investors. You buy units in the fund. The professional manager runs the fund for essentially a fee, the management expense ratio, and any gains or losses will be according to what happens to the investments in that fund. You receive all of the returns, including interest for any bonds that are held or any cash that's held in the fund, for dividends from shares, and from any capital gains. As I mentioned before, ETFs are kind of like mutual funds because they do create a pool, but you actually have an indirect claim in that through the ETF, and it trades like a stock. It trades on the exchange like a stock. You get minute-to-minute pricing, unlike mutual funds, which only reprice on a day-to-day basis. They allow you to diversify with very low level of investment. So a fund like XIC you can buy for about $25 a share. So if you had $100 to invest this week, you could buy 4 shares in XIC and do that on a week-to-week basis until you have a large enough investment pool to be able to specialize. Some ETFs become very specialized. There are high leverage bear and bull funds. So if you believe the markets are going to fall, you can buy a leveraged 2 times or 3 times leveraged bear ETF, which means when the price falls, you'll get 3 times the loss, and so on. Again, these become a little bit more specialized. As they become more specialized, they become less liquid, and also they become more expensive. There are quite high risks with some of those ETF strategies, and something that we should perhaps discuss a little bit more in class. This session has been quite concentrated, quite focused, and also very short. It's basically an introduction to a very large topic, but I would like to remind you at this point that first and foremost, the Know Your Client rule that stockbrokers work with is something that everyone should take to heart. Even if you're not working as an advisor, if you're working for yourself, you should know your client. Have a good understanding of how you feel about risk and return, especially. If you have got very low tolerance for risk, then you have to get used to the idea that returns will be logically a lot less than people who are willing to take the higher risks. Things like investment horizon, whether or not you're going to need the money out in a year or 3 years or 50 years will make a significant difference to the type of investments that you're going to make. Your tax situation can also be part of this. Liquidity, any special circumstances like beliefs or traditions that say we don't like interest-bearing instruments, or we don't invest in things like carbon economy or firearms or alcohol and tobacco, could be part of your of knowing your client as well. So if you're advising others, this is definitely something that is off the scale important. Know your client. If you're thinking about investing yourself, make sure you know your client. Not everybody should be investing in equities. Typically, equities are part of almost every portfolio. Perhaps 10 or 20 or 30% or 40% of a portfolio. In other cases, 60 or 70%. Portfolios should always be diversified. That means holding more than one thing. Not just real estate, not just bonds, not just equities, but an appropriate mix according to the risk-return profile for your client. I hope this has been interesting and useful, and I hope it's going to be a good companion as you read through that course material from the Madura and Gill textbook. I'll see you in the next video.